Hello everyone, thanks for joining us today. As before, the webinar will be led by Jerome Stern, Managing Partner, and our CIO, Chris Rosbach. They'll be joined by Giles Tulloch, who leads on our digital and technology investments, and by Katerina, who's Head of ESG, follows global stocks, and is co-portfolio manager of the WorldStar strategy with Chris. We plan to speak for about half an hour and then take your questions. We already have some good questions, but please do send more whenever you wish. I will now hand over to Jerome.
Thank you, Sandy. Good afternoon to everyone who has joined us. Thank you for taking the time. After a horrendous year, our WorldStar strategy has continued to perform. We're pleased with the resilience of the underlying companies in a volatile environment. Our firm manages around $1 billion, supported by active client engagement, encouraging flows despite the ongoing market pressures. About 25% of the firm's AUM are owned by my family and the partners, and the balance by other families, charities, trustees, wealth managers, and institutions. In October 22, our WorldStar strategy crossed its 10-year anniversary with around 800 million in AUM, delivering results in line with our long-term target return of 8 to 10% per annum or more. It invests in a concentrated group of 20 to 30 high-quality, sustainable, global large-cap stocks with enduring competitive advantages and a long runway of growth, selected through our intensive in-house fundamental research. Quality is the defining condition for a stock to be selected, followed by value. ESG is fully integrated into our investment philosophy, and we strongly believe in the correlation between ESG, sustainability, and investment returns. The strategy has been managed by the same team since 2014 and is available through separate managed accounts or through our UCITS fund, which is almost 4 years old. Investors can invest alongside my family in a strategy that has successfully generated strong returns for around 70 years, during which the world experienced wars, high inflation, rising interest rates, oil shocks, numerous financial crises, and more recently, a global pandemic. Our WorldStar's portfolio did not escape last year's significant market turbulence, driven by the enduring Russia-Ukraine conflict, alongside Western economies approaching peak inflation, and therefore central banks strongly tightening interest rates. Despite the resilience of the underlying companies, at 31st of December, our fund was down 24.6% in dollars, below the MSCI World Index, which to us, as steward of long-term wealth, is undoubtedly disappointing. We're nevertheless pleased to see that on a 5-year view, up to 31 December 2021, the WorldStar fund has delivered 136.9% in US dollars, 33% ahead of the MSCI World. As long-term investors, we see the current volatility as an opportunity, as valuations of our companies have compressed significantly, driven by multiple compression, and yet most of them continue to report robust trading conditions, thanks to their pricing power. I'm pleased to report that in US dollars, WorldStars began 2023 favorably, up 8.4% net of fees up to the 21st of January, well above the MSCI World and delivering compound annual growth of 9.3% per annum since inception. In British pounds, our WorldStars fund is up 5.9% year to date, above the MSCI World, after compounding at 12.2% per annum since inception, more than 5% above the FTSE for the same long-term period. Despite last year's difficult effect and ongoing volatility, our steadfast conviction remains that quality is the key driver for long-term, sustainable performance with solid downside protection. Long-term investors such as ourselves contemplate these volatile periods as buying opportunities, and we see smart capital looking to step in as prices decline. Interactions with our clients and prospects demonstrate to us that those investors will focus on quality businesses as they do in every recent crisis. We remain very optimistic about the global recovery over the next 2 to 3 years and confident in the ability of our focused portfolio to continue to deliver significant value over time. I will now hand over to Chris.
Thank you very much, Jerome, and welcome to everybody on the call. Thank you also from me for taking the time. I want to talk a bit about some of the things that we're seeing in terms of understanding the performance of the portfolio last year, but really then shift to updates on our current thinking about a number of issues that we're seeing, as well as the outlook for the full year. But the first thing that I want to say is that if we look at the performance of last year, it's really remarkable how very much it was driven by macro factors. One of the quotes that we like best of the many Buffett and Munger quotes that we can think of is that micro is what we do, macro is what we put up with, and last year was very much a macro-driven market. It was a market driven by the after effects of the pandemic, by the significant effects that the support that central banks and governments have had to expend in order to keep the global economy going. And I think that it's been a challenging period for companies and for markets as we get out of this period of transition, and if we go now into a period of consolidation and back to something that resembles the more normal growth and the more normal positive cycle that we expect. But the thing that I want to highlight here is that if you look at the rotation between factors, between growth and value, it's been really remarkable. We know that growth companies, and this is looking at the MSCI World, have outperformed value companies very substantially over the 10 years that we've been running the World Stars Global Equity strategy, but that has reversed very significantly. You can see here, and we've talked about it, that it did that in 2021 when it became clear that apparent that the vaccines were working, but it reversed as there was a second wave and as it was clear that there was further support that was going to be necessary. And we can then see that in 2022, the divergence occurred again and more substantially, although it has now started to stabilize and in fact has started to revert this year, which is something that you can see in the performance that our strategy has had on a year-to-date basis. But it's really very remarkable how strong this factor exposure has been and the impact that it's had. And the way we can see it, if we turn to the next slide, we can see it in terms of our own portfolio as well. Through our risk management system, we've looked at what the impacts of factors have been on our portfolio as opposed to the impact of stock selection, and that's very important. This has to be seen relative to the MSCI World. We're absolute value investors. We're not benchmarked at all, but in order to have these comparisons, you have to look at it on a basis relative to an index. And what you can see here is really quite remarkable. Since December 2020, so over the same period in which there's been this rotation, you can see that the pink line is the total active return that we've had, and the active share of our portfolio is very high. But you can see that the gray line is the selection effect, so the effect that the actual stocks have had and the decisions that we've made, as opposed to the dark blue line, which is the factor return, which are things like, in particular, value versus growth, but it's also valuations, interest rates, and other types of factors. And what you can see is that throughout the period, the actual selection effect has been positive, and actually quite substantially, if you look at it. And it's only in the third quarter of last year, coinciding with some of the earnings disappointments that we've had with some of the stocks, that it even reverted back down to flat. Of course, we want it to be positive, but in such a challenging year as we've had, I think we have to acknowledge that any kind of contribution is positive. You can also see it ticking up again from that perspective. And what this shows is that it really has been a very macro-driven market, and that for people like us who invest in companies, not markets, it is a challenging environment. But as Jerome rightly pointed out at the beginning, there's a long track record in markets, there's a long track record in terms of the Stern family, and of course there's also the track record that we have that says that these factors are ones that because they're macro-driven, are likely to revert over time and will mean that the returns will be driven by the results of the companies and not by these types of factors. And one of the things that I think this highlights is the resilient earnings that our companies have had. Jerome alluded to the fact that for the most part, they've delivered strong results. And as another aspect of understanding what happened last year, you can see here the changes in the earnings per share estimates that our World Stars stocks have had from January to December 2022. So in other words, looking at what the estimates were at the beginning of the year versus what ended up happening. And what you can see is that the weighted average of that is slightly down, but in aggregate, it's been really resilient overall. You see that there's plenty of companies, in particular on the consumer side, in healthcare and life sciences, and to a lesser degree in industrials and infrastructures that have actually had positive earnings growth over the year, despite the challenges, and that you can also see at the same time that the reason for the selection issues in that hit the portfolio in the third quarter, which is these issues in particular with digital advertising in some of our stocks in digital transformation that of course did have an impact and that have given us pause, but we've obviously spent a lot of time, Giles will touch on it, in terms of the causes for this and the point that we think that it does not impact the longer term picture or the attractiveness of this companies, even if in particular digital advertising is something that is challenging as we've moved through this period. I think one of the reasons for that is that one of the things the market struggles most with is difficult comparisons. And so if you've had a dramatic shift from offline to online as a result of the pandemic, and digital advertising grew by 36% in 2021, that these are very difficult comparisons for the market to then lap in the next year. And I think it's one of the reasons why the issues have taken place. But the point here is that in aggregate, the portfolio has been resilient in the face of the challenges of the interest rate increases, the overall increase in inflation, and in particular the increase in costs that many of our companies have had to endure, but it's because their businesses have done well, because they've been able to increase pricing, because in a number of cases, as you can see, they've been able to offset the price increases that they've had, the cost increases that they've had, that they've been able to perform in the way that they've had. So if we then shift from that to where the portfolio is currently positioned, this is a slide that we've shown you with an analysis that simply tries to understand where the portfolio is and what we mean by our focus on quality. And what you can see here is we've identified growth as companies that have EPS growth that is above 10%, ranging from 10 to 30. It is price to earnings ratios and valuation terms that are above 20. And we've said that value companies can have all sorts of growth because some of it might be recovery led, but they typically tend to be more lowly valued. And we've simply picked 20 here for the analysis that we're showing. And what you can see here is where we are positioned, both in terms of the dots, which represent the individual companies, but also with the blue dot, which is the weighted average of our portfolio. And you can see that this year, despite the issues, we're expecting earnings per share growth in aggregate above 10% for our businesses. And they're valued at just under 25 times price to earnings. We will talk about it in the outlook, but we think this is a very, very reasonable and attractive valuation that is lower than where it's been before. It's a combination, obviously, of where the share prices of the companies are and where their earnings are. But we think at this point where we're at, it is entirely compatible with the overall outlook, and very importantly, as we expect macro issues to settle, with the overall macro environment and where we think inflation and interest rates are likely to settle. So as a reminder, I just wanted to go over again just what we mean by quality and what we mean by value, in particular for those of you who are joining us for the first time. For us, quality is a gating condition. A company can be as cheap as it wants. If it doesn't have the quality we're looking for, we will not invest in it. We have 4 clear criteria for what we mean by that quality. It's a strong and sustainable competitive position, always also in the sense of ESG. We firmly believe that only companies that are sustainable in the way that they act, in which the way they treat their employees, their resources, their suppliers, and their customers can have sustainable competitive position and then generate sustainable returns over time. These companies need to be in a good and growing industry, so some reason why they should be able to do better going forward than in the past, and in industries that are consolidated so that the participants can make money from the activities that they undertake and have operating leverage and not have to compete away the margins that they make. Managements with a track record of value creation, so active engagement with managements, but not activist trying to change what companies do. We want to invest alongside management teams. As you know, we've defended a Swiss company, Sika, for 5 years against a hostile takeover from Saint-Gobain and members of their founding family. So we will be as active as we need to be to defend our interests, but we want to invest alongside companies and not against them. I think that's in particular relevant with some of the activism we're seeing. We've seen when some big hedge funds went after Pernod Ricard and after Nestle, we went public to say that what they were urging them to do, which is effectively more of the same, was largely right, but we hope that companies will not be distracted. And we're now seeing activist campaigns in companies like Walt Disney or Salesforce that we own, where we think there is in fact some change that may make sense, and so we're engaging and we're monitoring it very carefully. But again, we're looking to invest alongside those managements and the changes that they're looking to achieve. And then finally, the financial strength to weather any kind of adversity, which is very important. It's one of the reasons why the portfolio in aggregate has been able to perform the way that it has over the years. It's debt, how you get in trouble, whether you're an individual, a company, or a country. And so we're looking for businesses that have the financial resources to be able to be resilient. And it means that in a challenging environment like we've had throughout the pandemic, including the challenges that we had this year and last in terms of the cost pressures that companies have found, if they have solid balance sheets, they can then use it to their advantage. They may be able to reinvest. They may be able to in fact, buy weaker competitors and strengthen their competitive position. And these are the types of businesses that we're looking for. So these are the criteria that we look for. And for us, growth is a necessary attribute of quality, but it is only one of the ones that we look for. What is also a necessary attribute is value, which is the other factor that we take great care of. We have a universe of stocks that we look at. We have a watch list, we have an approved list, and we have a number of stocks on those that we think are great companies that fulfill our quality criteria, but that are too expensive. And it's in periods like this, when there is volatility, when there are mispricings, when short-term factor type drivers like we've had mean that stocks go down. This is a point for us when we can find great companies at much lower prices. And so we are looking to take those mispricings and use them to our advantage. It's one of the reasons why we bought, in particular, some of the stocks that we did last year. So with that, I want to conclude on this overall discussion, and I want to get into some of the specific updates that we want to give you in terms of both our overall positioning on sustainability, on stocks that we've added to the portfolio, and some other aspects that we think will be of interest. And with that, I'll turn it over to Katrina, who's our Deputy Portfolio Manager and Head of ESG. Katrina?
Thank you, Chris, and good afternoon, everyone. Now, you will have heard us in previous webinars talk about how we have been working over the last few years to deepen our ESG capabilities. And there are some areas I would like to highlight from our work on that front during 2022. Firstly, we are happy to have received the results of our first UNPRI assessment report. And I'm particularly proud to note that we were given 4 or 5 stars in 3 of the categories that we were assessed in. That is an important external validation of our ESG approach. Secondly, we continue to invest heavily in our ESG capabilities. And for example, have added recently a dedicated ESG data provider to complement our qualitative work in the space. Thirdly, we have expanded the scope of our collaborative engagement of the scope of the collaborative engagement initiatives we participate in. We continue to work alongside our peers and other organizations to drive impact, working with organizations like Share Action, as well as the Business Coalition for a Global Plastics Treaty. Finally, we continue to engage with our investee companies, with over 75 meetings held during the last year, looking into issues like capital allocation, operational performance, and ESG practices. And we continue to leverage our voice as shareholders on behalf of our clients by voting against management in 36 occasions, pushing for change and better outcomes in areas like diversity and inclusion, executive compensation, and environmental disclosures. Now, when we think about ESG, we often talk about policies, practices, targets that companies have. But one of the overlooked aspects is actually the revenue opportunities that a focus on sustainability can generate. And moving on to talk about a specific name, I would like to focus on Xylem. That is a name that is positioned as a key solutions provider in one of the most pressing environmental issues facing the world today, namely water. Now, we're all aware of some of the challenges surrounding water, but I would like to highlight a few key facts. Now, global per capita water supply has halved in the last 60 years, whilst demand continues to grow at a double-digit rate. Over 750 million people globally lack access to drinking water, and 80% of wastewater globally goes untreated. Now, you would think these are perhaps problems just limited to the emerging market world, but no. If you look at the statistics, over 10 million households in the US lack access to safe drinking water. And water lost to leaks features, frankly, weekly in headlines in cities like London. Now, the investment needed to address those issues is huge. The OECD has estimated that over 1 trillion in infrastructure spend will be needed annually to close the gap. That is a huge opportunity for us as investors. Now, looking at Xylem, it is one of the best ways to participate in this emerging super cycle in water investments. It is the global leader in water technology solutions, and it offers a wide array of products in the space across the entire value chain, that is from transport and treatment to usage and measurement. Importantly, also, it is the leader in smart water, that is digital solutions, one of the key tools through which to increase the efficiency of water infrastructure systems. Now, the opportunity in that area alone is huge, with digital solutions expected to grow from 35% of sales in the last year to over 50% by 2025. That gives you an indication of the size of the opportunity. And the key differentiating factor for Xylem in that space is its global installed base and deep domain expertise. That is what it allows it to play in the digital solution space and to win customers and convert customers as time goes by. Additionally, over 20% of Xylem's sales come from emerging markets. That includes China and India, obviously, as these countries put significant investment commitments in the space to address their water needs. And finally, the recent acquisition, $7.5 billion acquisition of peer Evoca, has further entrenched Xylem's position within the space. It has strengthened its position in the rapidly growing industrial segment specifically, ahead of what we see, as I said, an emerging super cycle of spend within the water area. Clearly a very interesting, a very compelling opportunity for us within the industrial space. And I think one that perhaps not all of you would have heard of. And with that, I will pass on to my colleague, Giles.
Great, thanks a lot, Katerina. Yes, I wanted to talk a little bit about some of the sort of cost-cutting and reduced headcount that we've seen across a lot of the large cap and mega cap technology companies. Indeed, over the last 24 hours, there have been further announcements by IBM and SAP and other two bellwethers of the technology sector who have been making cuts. As such, you can kind of see in the chart below that there's been some very significant layoffs over the last 2 quarters. This comes after a very lean period during the COVID-19 pandemic, especially in the second half of 2020 and throughout 2021, where there are no layoffs at all, basically. We've also seen as well, with these headcount reductions, we've also had a change in working environments. There's been a lot more remote work and hybrid work. And with that in mind, many of the tech companies have identified further cost savings from requiring less office space to go with this reduction in workforce. And so we think that this kind of readjustment of the cost base, it does mark an important change in approach and sort of mindset from some of the large mega cap tech companies. They have previously been focused on growth, and I would note, successfully grown their revenues and businesses significantly. But now they're also able to show some flexibility on the operational sides of their business. And so moving on to the next slide, we thought it'd be a good opportunity to delve just a little bit further into some of these headcount reductions that have been announced by some of the selected US mega cap companies. And you can see here, over the last 3 years, many of these companies have grown their revenues substantially, generating in the tens, and in Amazon's case, hundreds of billions more in revenues over this period. But in order to support this growth, they've also had to grow headcount as well, in order to best capture these opportunities that have arisen. And so we've now come out of the pandemic. The companies are having to sort of recalibrate their businesses and to best sort of optimize for the opportunities ahead. I think, as Chris mentioned before, growth is not likely to sort of keep up with that pandemic-infused growth. We had a little bit of a pull forward, and so headcounts are probably in excess of what's currently required. And so we appreciate the absolute figures of the reductions are large, again, in the tens of thousands of people. It still is a relatively low percentage of the overall workforce at these companies. It does highlight just how sizable these companies are and how important they are to the overall economy. And whilst it is a difficult decision to let staff go, I think with these reductions, many of the companies have noticed that they're going to move back to their core business models. They're going to sort of go back to what they were sort of famous for, where they sort of generate large, significant profits, where they generate high levels of free cash flow, and sort of pull away from some of the more experimental projects. And so after these sorts of cost-cutting announcements, we've seen the share prices of the companies rise in the main. It sort of does show again that investors like this sort of course of action, and we like the sort of improvements they can show in operating margins, as well as obviously continued revenue growth. And so to sort of conclude, we still think there are a lot of good investment opportunities in the technology sector. It has experienced a broad-based share price decline last year, but there are still some secular long-term growth drivers that are still very much intact. And also as well, just even the last month or two, new things like ChatGPT has really brought new enthusiasm around artificial intelligence. So we still think there are lots of areas of exciting innovation in the tech sector. We think that valuations have come down significantly, and we think that with this greater discipline shown by management teams, the sector is actually going to be a very attractive place to invest in, and it will perform again very well over the years to come. And so with that, I'll pass it back to you, Chris. Thank you.
Thank you, Giles. These are some discussions about some of the important issues that we've seen, and I want to add another one that we think is going to have a major impact on what is going to happen this year, and that is the shift that is taking place in China. Our colleague and senior analyst Zixin Xu has written an insight piece that discusses just how radical the change is that has taken place with the Chinese government taking completely about-facing on the zero COVID policy that they've had, and during the course of December effectively turning off the tracing apps and stopping the testing. So that, as you can see, the COVID cases in China absolutely skyrocketed, meaning that the fourth quarter of last year and the first quarter of this year will be somewhat challenging for companies that have direct exposures there, and certainly for the Chinese economy as a whole. But you can see how quickly the cases have dropped again. And so it is really remarkable how quickly the patterns in China have gone back to normal. And Zishan reports from Beijing that the subways are busy, shopping malls are full, and behavior is consumer behavior is rebounding very strongly in the way that it has to some extent here in the UK when restrictions were lifted, and the experience that we've had elsewhere. I think one of the really important things is that there's a very significant excess savings that have been built up. We think that that is going to have potentially a major impact, but also very importantly, we think that as Xi Jinping has succeeded in getting the third term and will have it confirmed in March of this year, it is entirely possible that the shift will go back to engagement and to achieving broad-based economic growth and prosperity in line with the 5-year plan that was adopted, and that calls for, after all, increasing the size of the middle class in China from 400 million people to 800 million people, making the same type of average income as people do in the US and in Europe by 2030. So a tremendous increase in the economy and in the number of consumers for the types of companies that we own. And so we think that that constructive outlook is also something that may well be something that occurs this year. And just looking at specifically the consumer spending that I alluded to, there's an estimate that the excess savings that have been accumulated by consumers in China not being able to spend their money during the pandemic could be as high as 12 billion renminbi. It could be between 5 and 10% of GDP. So an absolutely enormous amount of spending power that is going to go into consumer discretionary, into travel, into other areas, and means that it's entirely possible that demand there will offset some of the slowdown that we expect to see in the first and second quarter of this year in the US and in Europe. So that is an important and really quite game-changing impact of this change of policy. But at the same time, it also will have an impact on the global supply chain. One of the reasons for the cost inflation that we've seen is clearly the bottlenecks that have taken place as a result of the pandemic. And I think that as the Chinese economy reopens, and as particular ports and other parts of the export economy start working, we should see some of that abating. But of course, it does mean that there will also be inflationary pressures as Chinese demand for fossil fuels and for other types of resources increases. And so it's something we have to be aware of. But if it's against the backdrop of, I think, an otherwise positive economic outlook, then I think that is something that, again, we'll have to take into account, but I think it is not something to be overly worried about. And what's really striking, if you look at our portfolio, is the exposure of some of the companies to Chinese consumption. You can see how resilient some of them have been during the course of the year, in particular LVMH, the world's leading luxury goods company, but about a quarter of their revenues come from China. And so that should be a very positive impact as the economy reopens. But it's not just consumer companies, it's also industrial companies like Otis, which is in elevators and elevator services, or NVIDIA, which after all has significant exposure there, that is also impacted by the trade and regulatory issues that have taken place. But again, it's possible that those will stabilize and will benefit the company. So we're very positive about the outlook, and think that it's something to offset some of the issues that we may be facing in the first and second quarters of this year as we get out of this significant year of transition that we've been in. So if I can now shift from these more specific things to the broader outlook, I wanted to say that we continue to believe that we are looking at a positive cycle that is in the process of beginning. It's a perspective that we've had that we thought would frankly have happened in the first quarter of 2020 if it hadn't been for the pandemic. We've had a period of globalization that has delivered significant growth and prosperity. It has run a far way, but some of the issues have been exposed by the pandemic and by Russia's invasion of Ukraine. So we're seeing some realignments in terms of resources, in terms of where the locations of production and supply are. We're seeing friendshoring and nearshoring, which will on the one hand be more inflationary than the overall deflationary process has been, but on the other hand means tremendous opportunities for companies that are involved in the type of investment that's necessary for that. We're in the middle of digitalization. We're pegging it at 25%, but who knows? We've had several phases. We're only at the beginning of certainly the third phase, where we've had blockchain, where we're heading into quantum computing, where we're going to be seeing the metaverse in various forms as companies are working on it, and where with ChatGPT, which is the latest AI-driven innovation, we're seeing the tremendous potential of that technology to change the way that a lot of things that we do are done. And so we think that there's a lot of positive still to come. And as Giles alluded to, we think there's different types of places where that'll take place. We think that digital advertising continues to have its place, even if it has grown very quickly, and some of it may well have, the penetration may well have been accelerated by the pandemic, and the comparisons were so difficult that from Mark Zuckerberg on down, companies have struggled to adjust their businesses, including their cost base, for what the outlook would be. But at the same time, we think that there's great opportunities in software spend, even if some of that gets slowed down by concerns because it's a type of discretionary spend, but it is going to endure, and as well investment in more capital-based aspects of technology that after all will fuel this innovation, and that's in particular NVIDIA, but also other companies that are involved in that we're very actively looking at. But it really leads us to capital investment, which is the third phase that we see. It's the fact that there's not been sufficient investment in public and private infrastructure. It's the fact that there are great opportunities to implement capacity increases, to implement efficiencies, and to implement technologies that will help us address issues like climate change. It's in particular, that's one of the things that Katarina was speaking about in terms of our new investment in Xylem that we're very excited about, but we think there's a number of businesses that will benefit from it, and there were also some of the best performers in the portfolio last year, because that demand continues to be extremely strong. So if we shift and say, well, what does that mean for the outlook into next year, this year and next year, then we think that 2022 was a year of transition from this pandemic-driven period, from the significant measures that have had to be put in place. Overall, global GDP still grew. We've had this sharp shock in inflation, some of it related to the lack of capacity, some of it related to Russia's decision to invade Ukraine and to use energy prices as a point of leverage. It doesn't look like it's working. It appears that we will get through the winter in Europe. Germany in particular has been able to put in LNG terminals at record pace. And we've had indications that not only does it look like we will get through this year, but that we will be able to enter the winter season next year at 90% in terms of storage capacity. So taking away at least some of the concerns about the very high gas prices in Europe. And in the meantime, energy prices in the US have started to abate, and gas prices are back to pre-pandemic levels. So it's a perspective that I think is necessary with this extraordinary action that took place. But we have to understand that in this 2022 year of transition, what could have been, and what at the beginning of 2022, we would have thought would have been a 1 or 2 year normal process of recovery and of reopening, is something that, because of the very strong inflation, and in particular because of the energy price inflation, took place not over a year or two, but over 6 to 9 months. And that's this increase of US rates from effectively 0 to 4.25%, and target of 4.25% to 4.5% over the 9-month period. And that's something that, while the global economy, the US and European economy so far, have actually been able to handle, it is something that clearly markets were not able to handle. And that is just a reality. But I think that now that we're much closer to that interest rate level, and now that we're having inflation roll over, I think we will be in a very different type of paradigm going forward. And that's why what we're seeing for this year and next is that we expect inflation to fall sharply. We're seeing it in terms of stabilization already. we think that from that perspective, it should take off the pressure as interest rates get to the level that they need to. And on the micro side, I think the real question is what impact is that going to have on corporate spending and on consumer spending from this very short and sharp increase in interest rates? And there will be some impact, there will be some slowdown. It's what policymakers want. But whether that leads to another year of technical recession in the US like we had in the first and second quarters of last year, or whether it leads to something that is more benign, we don't see the indications at this point that it will lead to a very sharp recession or to a significant deterioration in terms of the outlook. We can't exclude that there will be externalities that might take place. There are some earnings expectations, I think at least on consensus, that are still somewhat too high. So some of that will have to come back. But overall, we think that it will be a year in which it will consolidate, in which we will then re-enter effectively this paradigm of a positive economic growth that would have taken place from the first quarter of 2020, and that is now going to be with us in a post-pandemic environment. And then just to highlight on these pages, we've put some of the numbers. I'm just going to touch on them. You see US CPIs coming off, both in headline and in core terms, and you can actually see this difference in gas prices, that it didn't spike anywhere near as high as it did in Europe. You're seeing that gas prices are down. Even in Europe, you're seeing that in China, costs have come off. You've seen container rates coming off. If we sort of continue on in sort of greater detail, you see that versus the consumer price index, both the ISM manufacturing index has come back. It's the slowdown that we were talking about. You see that money supply has also come back. So in fact, a lot of it has already taken place. And look how long the basically comparison is. So there's been a very, very sharp contraction that took place last year. And I think the point is some of the spillover effects may still carry on, but these big changes are behind us. And what's really important as we look out into this year and and next is to look at what valuations are doing. We've showed here what the MSCI is doing on average. This is the MSCI trailing price to earnings ratio, so the historical ratio, which is easy to track over the last 25 years. And you can see that that is now solidly below average. It could be lower, but the periods in which it is were periods of a very significant crisis. And we certainly think, therefore, that we're now at much more attractive levels for the overall market. That's important for overall sentiment. It's also important to note, I think, potentially as part of it, that we expect that one of the impacts on this price to earnings ratio has been the US dollar, which has strengthened as much as it did, which means that US earnings have been impacted by the translation impact. Again, one of the things markets can't deal with is disappointments in stated growth rates. We look through these currency fluctuations, but it has taken down US growth expectations. That's something that's going to normalize as the dollar at least stabilizes, and it's obviously started to reverse. And so that's another factor that I think is going to be supportive. And if we then switch to what it means for our portfolio, clearly, and this is now looking at the forward price to earnings ratio, which is 17.4 times for the MSCI World, and the bar on the bottom versus 24 times for our portfolio. We absolutely believe that the quality of the companies we invest in is worth the price, because as you can see, we have a revenue growth, including in 2023, that is going to keep up with some of the cyclical aspects of the index. We are expecting much higher earnings growth from our companies. They have much higher margins, and that, I think, is a reflection of the quality that we look for. And so we think that this 24 times price to earnings multiple as a shortcut for valuation is a very, very attractive level. And so in summary, and what we want to leave you with is our perspective that it's going to be a year of consolidation, of normalization. The first half is clearly going to be more challenging, but in the second half, as the comparisons get easier and as companies start to look forward and the outlook clears, we expect it to be significantly better. In 2024 could in fact be a year of going back to the type of cyclical upturn that we're looking at. And what's really important is that we think that both the global economy can do well in an environment in which interest rates are 3 to 5%, and where inflation is more elevated than it's been, but runs at, say, 2 to 4%. We think this is a world to look forward to. and not a world to be afraid of. And the valuations of our companies are entirely in line with that. We will have the performance of these businesses on an underlying basis. We don't need to have multiple expansion in order to generate the types of returns that we're looking for. And we think the valuations are now reset to levels that are very attractive. And so that's why we think from our portfolio perspective, there are a number of companies that we own that are coiled for performance, that are going to be based and perform in line with their fundamentals, where we've taken, in some cases, the pain of the multiple compression, and think we will be well placed for the environment that we look for. But I think one of the really important points as we conclude is, if we're wrong, if the outlook does not turn out to be as positive as we hope it is, if inflation is much higher, if central banks take much stronger action and raise rates further because of concern around inflation and cause a really serious recession, if there are externalities like an escalation in Russia, or contrary to our expectation, some kind of adverse policy move regarding Taiwan, and the global economy should be heavily impacted, then exactly the stocks that did well last year, the more cyclical companies, financials, and other types of resources and other types of businesses that were the sectors that did as well as they did, will get hit. And therefore, even from that perspective, our portfolio is much better positioned. We think it will generate absolute and relative performance if we are right, but if we are wrong, then at least the quality will prevail. And we think that it will certainly perform on a relative basis, and will then provide an opportunity to buy these stocks at lower levels. For that reason, we're very confident in our portfolio. We acknowledge the uncertainty of the outlook, but we base our views both on the fundamentals of what we're seeing at this moment and on our conviction in the approach that we have, the team, and the track record that we've built, that we think means that we are at a time of opportunity for long-term investors.